struggling to come up with a hefty down payment for a luxury rental property? In today's episode, we're going to reveal how to buy a high-end rental with just 10% down, thanks to our financing expert, Jeff Chisum. Hello. My name is Dr. Rachel Gainsborough, and I am obsessed with all things short-term rentals, revenue streams, and helping you navigate your career, real estate, and your busiest and most wonderful seasons of life. So grab your coffee, get comfortable as you get ready to learn and grow with me. This is the Luxury Rental Doctor Podcast. Hello friends, this season we are bringing you our exclusive highlights from our recent luxury midterm rental wealth retreat. Now, prior to coming to the retreat, people were saying interest rates in real estate are high, prices have gone up, we're in inflation. These are the concerns that hold many people back from investing, but what we are witnessing are a lot of amazing deals and one of the greatest wealth transfers in our lifetime. Now is still the time to invest. So I don't want you looking back 10 years from now and regretting missing this opportunity. In this episode, we have Jeff Chisum. He is a seasoned expert in the rental property financing realm. Now, Jeff recently closed on several of our members' deals within our community, and he consistently guides us and makes sure that we get our deals to go through. Jeff is amazing because he simplifies complex FHA loan regulation, and he gets us into action. The things that you think are true or not true, he busts all of those myths wide open. So thank you so much for joining us today. Let's dive in and learn how we can tap into this luxury real estate market.
Fort Worth, yeah.
Texas.
Dallas. You made sure that I knew that. Yeah. Not Dallas. Well, I was telling Ruben, we were talking about the schedule, and anytime I listen to podcasts, I always listen to it at 1 1/4 speed just to get through it faster, and I still think I can hear it, retain it, get it. I have a podcast, STR Home Financing. I will listen to it every once in a while. I don't listen to every episode, but I especially like to listen to myself at 1 1/4 speed because I'm from Texas. I'm pretty laid back, and I just like how I sound at 1 1/4 speed. So to try to keep up with the schedule today, I'm gonna try to talk at 1 1/4 speed. So hopefully you get something out of it today. I want you to write down 2 things I truly believe. And the second thing I want you to write down is the best is yet to come. The best is yet to come. So about a month ago, my wife and I, who is here with me today, Valerie. Yeah, give her a clap. We were celebrating our 26th wedding anniversary, and we were telling our youngest son, David, hey, can you believe mom and dad have been married for 26 years? And he goes, yeah, and you guys still like each other. That's amazing. So marriage isn't easy. Marriage can be really hard. There's challenges. And here's our exercise with those 2 lines. I'm going to say, but I truly believe, and I want you to say, the best is yet to come. So after 26 years of marriage, I truly believe the best is yet to come. The best, you got it. You're getting it. So our family, my oldest is Jace. He's 23 years old. He's a firefighter, paramedic, EMT. His first job was in rural Arkansas. So maybe 2 calls a shift, pretty laid back. And then he moved to the Dallas-Fort Worth Metroplex about a year ago, where he is in the middle of 6 major highways and a lake and a highly populated area. He's having some challenges with adapting to that. But for him, I truly believe the best is yet to come. His wife's changing jobs. She's in theater. My daughter, Callie, is 20. She's a nursing student. During COVID, she developed an autoimmune disorder. I'm going to get emotional about this one. Right now, she can't get a vaccine that she needs to get into her clinicals. She's defeated by it. We're working through it, but I truly believe. Awesome. So Caleb, I started working out with him. It's fun. He gave me the old, Dad, do you see that tricep right there? David if he was here right now, the first thing that he would do is a backflip for you. But he started jujitsu about a week ago, totally dominating. It's fun to see our younger kids develop and grow. And I truly believe, yes. So Ruben said we own 2 rentals. We had to replace that HVAC system. Serious money. You're looking at how great this model is, and then you got to write a check for $9,000. It can be defeating. Like, that's one of those things that slams you in the face, and you're like, no, why are we doing this? But then you have to remind yourself that this thing's been cash flowing. It will continue to cash flow. We're within our first 3 years, and it's just like any other business that it's got to grow, it's got to build momentum. You're going to have ups and downs. But we've already experienced over $100,000 in equity that property has grown in value. Same for our other property. So one of them is a lake house on the water. The other one's a golf course cabin. The golf course cabin had been a short-term rental before, so it had that history, but we had opportunities to improve what the previous owner did. So even with the obstacles, the things that have happened, I truly believe, absolutely. So my business, you guys heard mortgage rates are up? You guys heard any news about the economy? Yeah, so as a whole, the mortgage industry is down 70%. My business as a whole is down by 30%. If we close everything that we have locked in for this month, I will break a personal record for production. Let's go. Yes. So I don't have a mindset that there's all this stuff happening, let's go crawl in a hole, and neither do my clients. That's why my business is doing so well. The people that I deal with, they don't let interest rates keep them from doing what they want to do. It's just an obstacle. Is it a cash flow position obstacle? Absolutely. It costs you more. But they understand, and I truly believe the best is yet to come. Exactly. So by you guys being here, what you're investing in, what Rachel has put together, the resources, the expertise, what you'll get from this weekend, for your path and where you're headed as investors, I truly believe, wait, with some enthusiasm, I truly believe, yes, absolutely. So, oh yeah, I came to talk about financing. So I've got a quiz for you. And don't feel bad about this. And I'll go ahead and tell you, I'm going to give you the answers. So we're just going to walk through this because I don't have hard data, but I would say 90% of loan officers would fail this quiz. I'm going to guess, and I'm going to be conservative because I don't like to be wrong, but I'm going to guess there's like 3 people in here who've talked to a loan officer and you told them, hey, I'm super excited. I want to buy an investment property. Awesome. Well, you're going to need 20% down, 30% down. It's an investment property loan. You live in Chicago, you're buying a house in this investment property in Florida, and they never asked the question, that sounds like a great place to take a vacation. Is this going to be like a second home and you're just going to rent it out? That's why you're calling it an investment property? Well, yeah. They don't answer, or they don't ask that question as, do you ever plan on occupying that property? Anybody have that conversation? 1, 2, I need 1, 3. Yes, I was right. I knew there was at least 3 people. So this is 100% of my business is helping clients with the financing to buy these type of properties. Short-term rentals, vacation properties, lifestyle assets that also can be utilized as midterm rentals. So 90% of those clients are using the 10% down second home occupancy loan for their financing. So obvious reasons, the down payment requirement is lower than on an investment property. The interest rate is typically a whole lot better than what you'll find on an investment property loan. I bet there's at least 2 people in here that have had a conversation with a loan officer, and they have said that's not a viable option these days because the fees that have been put in place. Wait, 1, 2. Yes, I was right again. So Fannie Mae at the beginning of last year just decided, hey, let's try to figure out how we can eliminate a bunch of people from becoming wealthy through this product. So we're going to put a bunch of fees on it so they can't use this. It's no longer a viable option. So if you have a loan officer that's told you that the second home occupancy loan isn't a viable option, that's the reason why, is because Fannie Mae, Freddie Mac imposed these additional fees on that product to the point where, because you can't just charge whatever the government's put limitations in place, well, those additional fees have put those lenders in a position where they can't pass that fees test. So that's where you're getting these conversations that, yeah, we can't do that, or if we can do that, the rate's going to be 7 3/4. It's going to cost you 3 to 4 points to be able to do that loan. I'll share with you in a little bit a unicorn that I have that we don't have to deal with Fannie and Freddie. And when I say a unicorn, I don't know anybody else that's doing it. So for at least 2 people, this is going to be worth the price of admission because it's going to put you in a position where you didn't think it was possible to move forward with buying a short-term rental property, and we're going to find a solution with this product that's going to put you in that position to be able to take action. So to the quiz, because these are some basic understandings that you need to have about the product. These are some things that you will hear out there as misinformation around the product, because typical loan officer is only doing business that's centered around helping people buy their primary residence. So to help them with investor business or second home occupancy loan is typically a one-off. So is there anything that you do every once in a while, maybe once a year, and you have to go, yeah, I'm going to have to read how to do that again because I don't remember. Same situation. They just are not familiar with the policy. And that's where we've seen us devoting all of our resources, time and attention to this space helps our clients because we're familiar with the policy. We know what can be done, what can't be done. So the first one, how many days does Fannie Mae require you to occupy a property to consider it a second home? It is D. As long as you intend to occupy the property at some point during the year. So I'm glad somebody answered A, though, because a common crossing of lanes that I get on a regular basis is the IRS tax code and the mortgage rules. So the mortgage rules are, there's no specified amount of days that you have to stay in it or you are limited to staying in it. But there are with the IRS, right? 14 days is the most common, or the percentage of the amount of days that you have it rented. I will say something about the 14 days. Do you know that there's ways to exclude your personal usage from the 14 days?
Business? Renting it out to your business?
Well, yeah, so you can, if you're working on it, you save your receipts, you log your time, you can exclude that from your personal days. I am not a CPA. That's just a little personal experience. But yeah, always consult your CPA on any tax questions.
Jeff?
Yeah.
Question, the 14-day rule, do you have to do that for every year or just the year you purchase? Or is it a CPA question?
No, that's a great question. So it is a CPA question. But as far as, that's a good question from the mortgage side. And I don't remember if I included it on the quiz, but your commitment to that occupancy, those occupancy requirements, that you're not going to put yourself in a position where you couldn't occupy the property if you wanted, when you wanted to, is only for the first year. So after you own it for a first year, if you wanted to get into a long-term lease agreement, if you wanted to get into a legally binding contract after that first year, you could. Fannie Mae doesn't care. So number 2, Fannie Mae is okay with you renting out a home purchased with a second home occupancy loan on a short-term basis. Yes. So does anybody know why that is the case? Have you guys heard why Fannie Mae is okay? First of all, they don't want anybody operating in a gray area. And it makes sense to an investor who holds a note that on a property that's not a primary residence. Doesn't it make sense if they qualified on their own to support that principal, interest, taxes, and insurance payment to supplement that with additional income? It just makes sense. So the old policy kind of presented that as a gray area, whether you could do it or not. When they changed their policy a couple of years ago, it eliminated that gray area. But the reason why it's okay to book that or list that property on Airbnb, Vrbo, any of those marketing sites. So they're marketing properties to guests. They're connecting guests with owners. They are not, and you read it in the fine print, they're not facilitating a legal lease agreement. They don't have squatter rights. They don't have legal rights to stay in your property. If you had a property booked through Airbnb, or you had a guest that had booked your property on Airbnb, you decided that weekend, you know what, we really want to stay there. We're just going to cancel that. You can, because you have complete control. Nobody can sue you over that. There's no legally binding obligation on your part to let them come stay in your property.
So how does that work in connection with like longer stays?
So this is what I tell clients. You never want to put yourself in a position where a guest becomes a tenant in the eyes of the law. So the scenario is you have somebody that books through Airbnb, they stay 3 days, it's 5 days later, they're still on the property. You call the sheriff. Get these people out of my house. They're trespassing. You do a longer term stay, let's say most states are 30 days where someone staying in the property at that point has tenant rights. So they stay in at 35 days. It was booked for 30 days. Now you're going through the court system to have them evicted. So it's a much different situation. Fannie Mae shows up at the door. Who are you? Why are you staying there? I booked it for 30 days. I'm a tenant in this property. During that first year, that potentially could be a problem. Have I heard of the Fannie Mae police? No. I mean, do they wear uniforms? What kind of car do they drive? I don't know. But I'm a licensed loan officer. I have to tell my clients what the policy is to keep them out of trouble. Fannie Mae will allow you to quitclaim deed the title from your personal name into an LLC after owning the home for 1 year. True or false? True, right. And I did a podcast on this because I'm trying to think next year when rates drop, how do I make sure that my clients haven't put themselves in a position where they wouldn't be able to refinance? So you may want to check that out. I present the 3 most important things you need to know if you want to refinance. That whole, have you heard, marry the house, date the rate? Well, how do we break up with the rate when the time comes? So one of the things that I bring up is Fannie Mae will not allow you to hold title in the name of an LLC at the time of refinancing. So you just want to make sure that when you go to refinance, if you've transferred that ownership into your LLC, that you've transferred it back so you can refinance the loan.
Will it let you do it if it's in a trust?
Yes. Yeah, you can do it in a trust. Okay, number 4, what is the Fannie Mae loan limit for most areas in the United States? Close. No. C. Yeah, the conforming loan limit for 720 is 726.2. So typically Fannie Mae, Freddie Mac comes out with the loan limit for the following year right around October. So property values have continued to go up. We'll see that increase. So that's right around the time that you want to be on the lookout for when they'll announce what the conforming loan limit is for the following year.
And Jeff, that
so there's the high cost areas. So example of New York, San Francisco, some of those high priced real estate areas, which are few and far between. I would say that 95% of the United States is going to be under that conforming loan limit. And then you're going to have those high cost pocket areas around the United States. Good question. What is your max purchase price with 10% down in the Fannie Mae max loan limit? D, $807,000. So with 10% down, you can buy that $807,000 house. At North Point, we have the ability to do a piggyback second. So a lot of people have heard of like a 80-10-10 or 80-10-5 to try to stay out of PMI. We can do the same thing, but it's all based on the conforming loan limit in that first lien position. And this is someone that's trying to max out their purchasability with that 10% down loan. So 726.2 on the first lien, $250,000 on the second lien, 10% down is going to back you into a max purchase price of D on number 6, $1,084,000. Number 7, Fannie requires a property to be a single unit. What property type are they not fond of when it comes to second home occupancy loans? 2 correct answers. C and D, that's right. Condos and tree houses. But I will say this. What's that?
I was just thinking about a treehouse.
Well, yeah, that's the whole private money loan. Who wants to lend out of their self-directed IRA type thing. But as far as conventional financing, it's got to be construction that is common. So like we're not seeing any financing on the container homes, the tree houses, but then sometimes it comes down to comps. So my best example is, okay, you want to buy a log cabin in the Smokies, that's no problem. There's plenty of them, plenty to choose from when it comes to comps. But if you want to buy a log cabin in New York City, that's going to be a problem. There's no comps for log cabins. The other thing that I would touch on is condos. Who's explored the condo route and tried to do the 10% down loan? No one? So Fannie Mae and Freddie Mac made a shift a couple of years ago to where they really only wanted to do deals in units and developments or developments and buildings where those buildings were primarily people's primary residences. So how do they know that? Owner's address, property address doesn't match. It's their second home more than likely. So when I talk to clients that are looking to buy in Destin, coastal Carolinas, mostly beach type destination areas, I tell them switch lanes if you want to do that 10% down loan, because those condos aren't going to qualify for that 10% down program. So you're really going to want to look at single family homes, or there may be opportunities through townhomes. Now, Nashville, Tennessee, St. Louis, Missouri, San Francisco, where people are occupying condos as their primary residence, and that's a common dwelling type, then there may be an opportunity to do that 10% down second home occupancy loan in a metropolis type area. If the lender finds out the property is operating as a short-term rental and they see in the contract that furniture will convey, current book of business will convey, the loan will be denied because Fannie Mae will not buy the loan. True or false? False. So here's the value of dealing with a lender that does a lot of these deals versus a lender that does them every 5 years is we know what is allowed in contracts and what is not allowed. So if we see something in a contract that's going to cause an issue, we'll send it back and say, hey, this can't be on here. This is going to kill a deal. So that is very important knowledge to have. The second home writer states at closing that I can't lose control of the property. Does that mean there are 3 correct answers? I can't have a property manager. I can't participate in a timeshare arrangement. I can't execute a legal lease agreement where I can't occupy the property when I want to. I need to clean the house on a regular basis. So the answer is B, C, and D. So you can have a property manager. The only thing that you want to be careful there is that there's not language in the contract that states that you have to make the property available X amount of days per year or X percentage of the year, or you're going to be in violation of the contract. So they take a certain amount of control over your ability to occupy the property because they're telling you that you have to make it available a certain amount of days or a certain percentage of the year. Does that make sense? Because I get that one all the time. Well, I've been told that I can't have a property manager. That's just not true. When it comes to proximity for my primary residence to qualify for a second home occupancy loan, the property has to be at least 50 miles from my primary residence, in a different state as my primary residence. In Hawaii, there is no distance requirement. Somebody say A, you don't have to raise your hand. Yeah. So that's old policy. There's no written mileage requirement. It just has to make sense. I was telling Ruben, I had a client in Dallas, and it was just coincidental that they were in that other world from Fort Worth, but just right down the road, where I understood when they told me that this house that they were looking to buy was 20 miles from their house, which doesn't sound like very far. Well, I know in Dallas, that could be an hour-long drive potentially, just depending on what's going on the highway. She was buying the house because her kids swam competitively at this swim center. She wanted a house there for when they had meets or when they were going to have these camps that they were going to have practices. She just didn't want to be in a position where they would be late or they were driving back and forth. And she put that in an explanation, made sense to the underwriter, and we did the deal. So there is no mileage requirement. It just has to make sense to the underwriter. We've had the same thing with lake communities. So you live in the suburbs or you live in the city, there's a lake community, 30 miles away. You like to go there, you like to stay there, you'd like to own something there, you'd like to have a short-term rental there. That would make sense. You just have to be able to logically explain it to the underwriter. What is one of Jeff's favorite strategies for funding down payment, closing costs, and make the property guest ready? Yes, so check out my podcast, How to Create Your Own Down Payment Bank. That episode, go into detail on that. DSCR. Anybody heard of DSCR? Debt service coverage ratio. So the question I get all the time, because I'm not typically talking to a client about doing a deal. I'm usually talking to a client about building a relationship because they want to build a portfolio of these types of properties. So the question I get all the time is, Jeff, how do people scale? DSCR is one of those ways to do it because there's no debt to income ratio standard. We're no longer looking at your personal income to qualify. We're looking at the property's ability to cash flow and meet the PITI payment. So gross income projection against PITI payment is what we're looking for approval. This product was created for long-term rentals, so that one-to-one ratio in the short-term rental world is very conservative. When we get that short-term rental data, we can show short-term rental cash flow. We blow that ratio out of the water. It is the easiest loan that we do in this space. Experienced investor is required to put down 20%. An experienced investor is someone who's owned a cash flow producing property for 12 months in the past 12 months. There's a lot of companies that will not do loans for new investors. North Point, we do. So it just requires that you put 25% down instead of 20%.
What is considered cash flow? Like, is it a number or just as long as you cash flow?
It's cash flowing. It doesn't have to be positive cash flow. Yeah, so you could be in a negative cash flow position, still be considered an experienced investor. And then you guys, here, we'll walk through these real quick. So DSCR, you can do the loan in an LLC, you can hold title in an LLC. You are required to be a personal guarantor. That's going to go on your personal credit. That's important to remember. Reserve requirements, you have to have 6 months of reserves for the subject property. So if you own 10 properties, This isn't saying that you have to have 6 months of reserves for each of the properties, just the subject property for PITI. Yeah, so the 1-to-1 ratio is on gross cash flow. The only other thing that I want to mention, and I'm not going to go into details, but the way that we bought our second property, when we're looking at outside the box type things, we also do investment property loans. So investment property loan is typically right now in today's environment with where pricing is, you're going to need to put down 20 to 25%, even though the minimum down is 15%. Because again, somewhere at Fannie and Freddie, they said, we don't want rich people to get richer. We're going to require them to put more money down. So even though the minimum down payment is 15%, you can't pass a fees test. So you need to put down 20 to 25%. It is a fully qualifying loan. So there's a debt to income ratio standard. But the difference on the investment property loan is that we can use 70% of the market rental comps towards qualifying income. So unlike the second home occupancy loan, where we can't consider potential income for qualifying, we can on the investment property loan. So interest rate's probably going to be about 2% higher. The costs are going to be higher, but it is another way to scale. Self-directed IRA, anybody with a non-recourse loan? Research that one. Google it. I don't have time to tell you about it. But it's the way I bought my second property. I don't. Yeah, N8 National American Savings Bank is who I use for mine, and they did a good job. But as I've watched the stock market, I'm a pretty simple guy. I like to say, cabin, golf course cabin, it burns down. I have an insurance policy. What happens in the stock market and what's lost, I don't know the stories, can't explain the stories, I don't know where that money went. So I just like to keep it simple.
Do you do portfolio loans?
Define portfolio loans.
So like a group of single-family homes?
Okay, no. Yeah, so there's two different ways that people, when they say portfolio loan, there's kind of two different meanings. One is, I have this portfolio of properties, I want to do a loan against it. So they'll take that as collateral. It's kind of collateralized lending. Portfolio, the other way portfolio lending is looked at is the bank has loan products where they're going to keep that loan in their portfolio. So they make the rules. So our bank statement loan is a great example of that. So for anyone that's in here that's truly self-employed, 100% self-employed, and your bank account shows a whole different account of your cash flow than your tax return does for obvious reasons, we'll extrapolate a qualifying income calculation from your bank statements instead of using your tax return to qualify you. That's a portfolio loan for us. We can still do the 10% down on that as a second home occupancy loan up to $1 million loan amount. So it's a pretty nice opportunity. Now, there's two different sets of self-employed people. One, they're super busy. Jeff, don't ask me for a single document. Put me in the DSCR loan. The other one is, I want the best opportunity. I want to take advantage of a 10% down loan. I'll send you whatever you ask me to, and they'll jump through the hoops of the bank statement loan.
So, do you have a collateral loan for property you already own, or do you have a referral for it?
We do not, yeah, and I don't have a referral for that. Yeah, typically, from my own personal experience, like when I sat down with a personal banker, business banker, when I was thinking about long-term rentals 7 or 8 years ago, because at that point, the vision was, we'll earn 30 or 40 of these, but what does it turn into once you own 3 or 4? What does the lending look like? So I met with a regional banker. They did have the portfolio loan, but that's my experience, a more regional opportunity because they know what they have, they know what's there, they can go put their hands on this real estate. So anyone that wants to schedule a call with me can go through my website, STR Home Financing.
That's right.
There's a link to my calendar. I book my calls so it's not, hey, give me a call, and then we play phone tag. You'll be able to pull up my calendar, match it with yours, and we can get on the discussion.
Jeff tremendous value. Give it up for Jeff.